The role of hedge funds in financial markets. Hedge funds are private investment vehicles that pool capital from accredited investors and institutional clients with the aim of generating high returns. They are known for their aggressive strategies, broad investment mandates, and ability to employ leverage and short selling. While hedge funds make up a relatively small portion of the financial market in terms of assets under management, their impact on financial markets is significant. This article explores the role of hedge funds in financial markets, including their strategies, benefits, and the risks they pose. What are hedge funds? Hedge funds are alternative investment funds that engage in a wide range of investment activities, including equities, bonds, currencies, derivatives, and more. Unlike mutual funds, which are heavily regulated and must adhere to specific investment restrictions, hedge funds are less regulated, allowing them to pursue more aggressive strategies. Key characteristics of hedge funds include flexibility. Hedge funds can invest in almost any asset class and use a wide array of strategies, including leverage, derivatives, short selling, and arbitrage. Accredited investors. Hedge funds typically cater to wealthy individuals and institutional investors, such as pension funds and endowments. Performance-based fees. Hedge funds usually charge a management fee, around 2% of assets, and a performance fee, typically 20% of profits, aligning the fund manager's interests with those of the investors. Strategies used by hedge funds. Hedge funds employ various strategies to achieve their investment objectives, each with its own risk and return profile. Some common strategies include long-short equity. In this strategy, hedge funds take long positions in stocks they expect to increase in value and short positions in stocks they expect to decline. The goal is to profit from both rising and falling markets while minimizing overall market risk. Global macro. Hedge funds using this strategy invest in global markets, taking positions based on economic trends, interest rates, currencies, and political events. These funds may invest in a variety of asset classes, including currencies, commodities, bonds, and equities. Event-driven. This strategy involves investing in companies undergoing significant corporate events, such as mergers, acquisitions, bankruptcies, or restructuring. Event-driven funds aim to profit from price discrepancies that arise during these events. Arbitrage. Arbitrage strategies involve exploiting price inefficiencies between related assets. For example, convertible arbitrage funds may take long positions in convertible bonds, bonds that can be converted into equity, and short positions in the underlying stock. Distressed securities. Hedge funds may invest in the debt or equity of companies in financial distress, often buying these securities at a discount. The goal is to profit from the recovery or restructuring of the company. Quantitative strategies. These funds use mathematical models and algorithms to identify investment opportunities. Quantitative hedge funds often engage in high-frequency trading and other strategies that rely on large amounts of data and computing power. The benefits of hedge funds in financial markets. Hedge funds play several important roles in financial markets, offering benefits to both investors and the broader economy. Market efficiency. By employing sophisticated strategies, hedge funds can help to identify and correct market inefficiencies. For example, through arbitrage, hedge funds help align prices of related securities across different markets, contributing to more accurate pricing. Liquidity provision. Hedge funds often trade in large volumes, providing liquidity to financial markets. This liquidity is particularly important in times of market stress, where hedge funds may step in as buyers or sellers, helping to stabilize markets. Risk management. Hedge funds offer diversification benefits to institutional investors by providing exposure to alternative asset classes and strategies that are not correlated with traditional investments like stocks and bonds. This can help manage risk and improve the overall risk-adjusted returns of a portfolio. Capital allocation. Hedge funds often invest in emerging industries, distressed companies, and innovative sectors that may be overlooked by traditional investors. By doing so, They help allocate capital to areas of the economy that have high growth potential or need financial restructuring. Innovation. Hedge funds are often at the forefront of financial innovation, developing new strategies, instruments, and technologies that can be adopted by the broader investment community. Risks associated with hedge funds. While hedge funds offer potential benefits, they also pose several risks, both to investors and the broader financial system. Leverage. Hedge funds often use significant leverage to amplify returns, which can also magnify losses. In periods of market volatility, highly leveraged hedge funds can be forced to liquidate positions quickly, exacerbating market declines. Lack of transparency. Hedge funds are typically less transparent than mutual funds or ETFs, providing limited information about their holdings and strategies. This lack of transparency can make it difficult for investors to fully understand the risks they are taking on. Illiquidity. Some hedge fund strategies involve investing in illiquid assets, such as private equity or distressed debt, which can be difficult to sell quickly. Investors may face restrictions on withdrawing their capital, leading to potential liquidity issues. Systemic risk. Due to their size and interconnectedness with other financial institutions, hedge funds can pose systemic risks to the financial system. The failure of a large hedge fund could have ripple effects across markets, as was seen during the collapse of long-term capital management, LTCM, in 1998. Regulatory risk. Hedge funds operate with relatively little regulation compared to traditional investment funds. This lack of oversight can lead to higher risks of fraud, mismanagement, or excessive risk-taking. However, regulators have increased scrutiny on hedge funds since the 2008 financial crisis. Hedge funds and market impact. Hedge funds have a significant impact on financial markets, both positive and negative. Price discovery. Hedge funds contribute to price discovery by taking positions based on their research and analysis. Their trading activities can help ensure that asset prices reflect all available information, improving market efficiency. Volatility. While hedge funds can provide liquidity, their rapid trading strategies and use of leverage can also contribute to market volatility. In some cases, hedge funds may exacerbate price swings, particularly in less liquid markets. Influence on corporate governance. Hedge funds often take large positions in companies and can play an active role in corporate governance. Activist hedge funds, for example, may push for changes in management, strategy, or capital allocation to unlock shareholder value. Contagion risk. Hedge funds are interconnected with other financial institutions through borrowing and trading relationships. In times of market stress, problems at one hedge fund can spread to others and to the broader financial system, as seen during the 2008 financial crisis. Hedge funds and the broader economy. Hedge funds can also influence the broader economy in several ways. Investment in innovation. Hedge funds often invest in innovative companies and sectors, providing capital to areas that might struggle to attract funding from traditional sources. This can support economic growth and technological advancement. Corporate restructuring. By investing in distressed companies, hedge funds can play a role in corporate restructuring, helping to turn around failing businesses and preserving jobs. Influence on monetary policy. Hedge funds' trading activities and positions can influence interest rates, currency values, and other economic indicators. Policymakers may take hedge fund activities into account when setting monetary policy, particularly in areas like market stability and liquidity. Conclusion. Hedge funds play a multifaceted role in financial markets, offering both benefits and risks. They contribute to market efficiency, provide liquidity, and offer diversification benefits to investors. However, they also pose risks related to leverage, transparency, and systemic stability. Understanding the role of hedge funds and the implications of their activities is crucial for investors, policymakers, and regulators alike. As the financial markets continue to evolve, the role of hedge funds will likely remain significant, influencing everything from asset prices to corporate governance and economic growth. I do not provide personal or financial investment advice, and I am not a qualified licensed investment advisor. This video's educational purpose is only to give you the basic idea. If you need a personal or financial advisor, please seek help. Embrace the journey, ignite your passions, and join us as we explore the extraordinary together. Please like the video, and turn on notifications for future uploads. Thank you.